everything in the market. FOMO, the biggest pitfall of traders in any market.
I'm on my second win. He done flexed before, now watch him flex again. They was mad at first, I bet my life they be upset again. Stepping in, cool with all these bouncers, got these weapons in. God still on my side, it really got me feeling blessed. Stepped and we gon' step again. Quickly disrespect his chin. Not a fan of back and forth, I'm representing excellence. Bank run, tell a blue hunt's my preference. Poverty, they never acknowledged me, so embarrassing. Gossip I ain't never like.
What's up, guys? It's your boy Edward. I'm back with another episode of Commas and Culture, and today we're going to talk about 3 tips on how you can get better entries in the market. Now, it doesn't matter what instrument you're trading, whether you're trading Forex, crypto, futures, options, whatever financial tool you want to use, instrument you want to use, you can use these tips and dominate across all sectors. So I'm going to get right into it and talk about the 3 ways that you can go ahead and refine your entries and get better entries in the market. All right, guys. So many of you guys have heard of the concept or the idea of when you're trading, whether stocks, whatever market, you always want to buy low and sell high. That's with buying pretty much and selling anything, right? It's with capitalism in general, financial markets in general. One tip I can give you, to make this concept of buying low and selling high, especially as a new trader, is entering on opposite candles. Trading is all about buying low and selling high and vice versa. You always want to be looking for a discount. So why buy on a bullish candle or sell on a bearish candle? Always wait for the pullback and enter on the opposing candle. One trick that can help you is switching, especially like with your psychology, switching the colors on the candle. So if you guys look here, you notice whenever you see the market heading to the upside, the candles are actually red. When it's the downside, the candles are actually blue. So obviously you're not going to be trading every single candle, right? But you can use this as an extra means of confluence. When the market is going to the upside and you see it red, that means it's discounting in order for you to sell. So when you see the red, you should be looking for sells. We're on the 4-hour time frame right now. We could maybe go to like a daily. And we could see, for example, right here, Monday 27th, we had this closure of a red candle. This was our discount right here. Next day, what happened? We sold. Next day, what happened? We had a blue candle, which essentially is really a bearish candle. But this is our discount here, and the market bought. We bought from these lows. So this is most apparent on the daily candle, daily time frame. Excuse me, not daily candle, daily time frame. You can see these discounts more clearer. On the lower time frames, it's going to be a little bit more confusing, but just play with it, see how you can kind of mix it in with your strategy. Set your candles to opposing colors, opposite colors, and I bet you it'll help you get better entries. Look right here again, Wednesday the 27th, we had this bullish candle here, this wick, and again, red candle sold. Right here, we had this bluish blue candle, kind of setting us up for a buy scenario, and eventually we had a bull run to the upside. So obviously you're not just going to use this when entering. This is just one means of kind of getting your eyes trained to see where the discounts are, right? So that's tip number 1. All right, so tip number 2, we're back on my kind of regular charts now. Now tip number 2, we're going to talk about Fibonacci. Now, using higher time frame Fibonacci levels, whether it's daily, weekly, and monthly, is going to help to give you sharper entries. But it also depends on how you draw the fib. There's many people do from like highs to lows on an impulse move. Like, for example, some people will draw this swing low to swing high and then call this a valid fib pattern. Yeah, you can do that, but that just takes way too long for levels to hit, and it's just it's just not as accurate, not as duplicatable. I'm gonna get into a little bit on how I draw fibs, just a tiny bit, but you can watch one of my previous videos, the Fibonacci hack video, to show you guys, or to see kind of how exactly I draw fibs. But basically, if you guys aren't familiar with Fibonacci, the fib tool is designed to use mathematical ratios to measure moves in the market. This aids us to identify potential pullback areas in order to locate probable areas in the market that will either reject or respect. So in accordance with using the higher time frame, this gives us a more likelihood that these levels will be rejected or respected. So using higher time frames like the daily or the weekly gives us more information. It aggregates more information in order to give us a high probability. So I'm just going to use the weekly as an example here. We'll use the rewind tool to give you a clear example. Let's see, like, for example, right here, right? So let me just go back just a little bit. Oh, what am I doing? So
What are you, a monk?
right here, right? This was the beginning of January. This is the beginning of the year, right? We saw that the market closed bullish. We broke this structure here. Market is still in a somewhat indecision phase because we're still at this structure here, but overall the most recent price is bearish, right? So what I would do is, since we're on the weekly time frame, first of all, I do Fibonacci on multiple time frames, but since we're on the weekly time frame, we would first start our top-down analysis by drawing from the high to this weekly candle to the low. This will give us key levels, key ratios that we will look out for going into the next week, right? Then we can go into our daily time frame. So it's still Friday of this current week. We're going to the next week, Monday. We can see we tapped into some key areas here. We have our golden ratio, our 618, and market made a high right below this 78.6, right? Trading into Tuesday, we could have taken advantage of this 78.6, right? We saw the market made a high here. It gave us that discount. Boom, we filled the 78.6, could have potentially gotten a wick entry. And then we follow this same pattern going in later into the week. We can even use this daily time frame. Again, refer to my video about Fibonacci, but what I would do is use Monday's daily range or daily high and low to draw my daily fib. And you can see going into, let me just erase this real quick. Going into Wednesday, we essentially got another daily rejection off the 38.2. So this is little to no drawdown, right? A little to no drawdown in these areas. This would have been a nice trade coming for London, but we essentially sold off from this fib level. So using these fib levels can give us a stronger probability of having less drawdown, being closer to when the actual market move will happen, drawing the fib in this fashion, right? So again, I'm going to show you guys, look at the weekly fib, right, from high to low, and look how the week ended up, right? We straight up just rejected this 618, and we ended up closing down here at this fib extension here. So this is all, the Fibonacci just gives us a framework to trade with, right? We see how accurate this was. Now let's go into the next week really quick. So this is Monday, right? I would draw a bullish fib here. I might consolidate, but you can see here the following week, boom, 618. It's a weekly time frame. Right off the weekly fib level coming off of Monday, and boom, we pretty much were bullish going right through the middle of the week. You can also see Friday we can draw our, or excuse me, Monday we can draw our daily fib on Monday and see how we have confluence going into Tuesday from the 618 and boom. This is how I plan my entries. They're around these key fib levels on the daily and weekly time frames. So I'll be getting these sick entries, right? And then Wednesday we changed the fib, right? In terms of daily time frame, we'll be going like from Monday to Wednesday because it's the middle of the week. And we got the direction wrong. I'm just kind of shooting in the breeze here, but you get the idea, right? You want to use these fib levels. It helps you to get sharper entries. So that's tip number 2, using higher time frame Fibonacci levels to find high probability areas where the market will reject or respect. All right, guys, now tip number 3, after you identify these levels on higher time frames, you don't want to be executing necessarily on these huge time frames. You want to execute on a smaller time frame. For me, I use 5 and 15 minute. This will help you catch the beginning of the move. Once your area of interest is filled, either from the fib tool or whatever confluences you use, you know, whether it's supply and demand, fair value gap, or whatever means of confluence you use, just make sure you're entering on a lower time frame and use candlestick formations and patterns such as engulfing patterns to catch those tight entries. So for example, right, we had this move coming off of Monday. Let's just rewind again one more time. Let me show you guys a quick example because this video is getting a little bit longer than I was anticipating, right? So my confluence I use is fibs, so we're going to use the fib again, right? Already we see that this candle broke this structure here. We closed bullish. The open was higher, so this is going to be a bullish fib, right? I'm going to be looking out for these key areas to be filled. More than likely this 38.2 and this 618. So what I'm going to do around my trading session, whether it's London, New York, I'm going to be looking for these levels to be filled on a lower time frame. So let's just fast forward a little bit. I'm going to start with the 1 hour. When I speed things up a little bit. I went too fast here. Let's go back. So we got filled here. This is around pre-London. Still a little bit early to trade. I realistically wouldn't have entered this early. We're closer to actual London. So you can see here the market came back down. Still pre-London. This is about 12 o'clock or right before 12 o'clock. And then we come into German session, London session comes, and market's still pulling back. London session opens, and we actually fill this 618. So 618 fills. This is pre-New York. And we drop to the lower time frame, and we're gonna look for engulfing candles, different candlestick patterns. Honestly, for me, I'm trading New York open. I don't really trade London or anything. If you guys follow me in the group, I only trade New York open. So you can see here after New York open, we came back down, retested the 38.2, bam, engulfing candle. We could have entered either at this candle close right here, or we could have also entered, you know, if we really wanted to be have an aggressive entry, we could have entered at this candle close, right when this candle closed here, right? You're able to catch those sharp entries when you're on the 5-minute time frame or the 15-minute time frame. 15-minute, you know, you would have only really been able to catch here because we filled it on this candle and then we ended up closing up. But again, you want to catch it when it's red. So this is when you mix all 3 steps together, right? This candle at one point was bearish before it flipped, so you would have caught it at the bearish candle, which is this. This is the buy candle right here, and then boom, you see it went right up. So you wouldn't have caught this on a 15-minute time frame. It's bullish. On a 5-minute, it's bearish. And because you're using the confluence with the higher time frame Fibonacci, or it's a high chance that it's gonna go in your direction, right? So that's pretty much all I got for you guys. Hopefully that makes sense. Those are my 3 tips of how you can get entries. Make sure you watch the Fibonacci hack video so you can guys get a better idea of how I draw fibs. With that being said, I'll see you on the next video. I'm out. Peace.